And Robert sent us a question just prior to the webinar, earlier this afternoon, around 3 o'clock, I think, maybe a little bit earlier. But in any case, Robert's question was, I have been trading the SPX and I'm interested in the purpose of the AM options. I understand how the monthly AM options work. Next day reconciliation of SPY component prices establishing the set price. And what that means, of course, if you're not familiar with that, is that the regular third Friday expiration for SPX are AM settled. That means the last time you can trade them, do any adjustments, close the positions, is technically Thursday before 4 o'clock. When the market opens, essentially you cannot trade the options anymore. It's the settlement price in the AM of where the 500 stocks on S&P stood, and that price is the closing price, as you mentioned, the SET on Yahoo Finance, the set price and so forth, is where it ends. But as it's calculating for that first 10, 12, 15 minutes on Friday morning, you can't do any actions. You had to already have done them by Thursday. And of course, he says, versus the regular options. And the only reason I ever deal in the AM options is when I'm forced to, because no regular options are traded. For example, if I want to position in a 6-month leaps position for a poor man's covered call in SPX, the AMs are the only options available. And those will most likely be rolled out periodically. So, Mike, can you explain, at least shed some light on why option traders would ever deal in the SPX AM options with all their overnight pricing uncertainty rather than stick with the regular SPX options? Just curious. All right. Well, let's tackle that. Last part first. Robert had mentioned, why would anyone ever deal with the SPX AM options with all their overnight pricing uncertainty? Why is that a concern? Well, if I'm holding the 4,000 call, for example, and Thursday night, SPX closes at 3,998, and I didn't close that option. I didn't buy to close it for the price. I was just assuming it would expire. But on Friday morning at 9:30, 9:35 or so, the SPX opens at 4,009. Call is now 9 points in the money that I sold. Maybe it's part of a bear call credit spread. That's the uncertainty he's talking about. You don't know what the settlement price is going to be till after the open, and I can't do any adjustments. I would have had to do it all Thursday before the close. But why would anyone do the AMs rather than stick with the regular SPX options? Well, Robert, remember, the regular SPX options are the AM settled options. This is how they've always been available since they were on the market, since the 80s, since 85, since 2000. The AM settled SPX options were all that there was. This is the venue that most floor traders use. They probably use some weeklies now, but you see a lot of activity still in the AM options, and a lot of that is the floor traders, hedgers, and international markets as well, using that European AM-styled thing. Now, all of them are European, of course. Don't get me wrong. You can't be assigned early on the PMs or the AMs, but this, on SPX, these are the regular ones. The AM are the regular, known, and commonly used one of the floor traders. Now, you also know there are end-of-month options, which are PM settled as well. So you also have the 30-day or the 31-day. And it all gets confusing now, but we're going to talk about all the flavors of the SPX options. There are 6 flavors of the SPX options. We have the standard AM settled options that expire on the 3rd Friday of the month. Those are the regular options that have been around for decades. These are the ones that are mostly traded on the floor. They have wide bid-ask spreads, and you have the set price. There's 4 versions of PM settled options. Just to make it more troublesome, in addition to the weeklies, you now have the Mondays, the Wednesdays, and the Fridays, the end of the month, and the quarterlies even. Those are all PM settled series. Now, all of those will show up under the SPX chain, but their ticker for anything that's not the standard will be SPX.W versus SPX. Now, if this last sentence here, the quarterlies are always going to trump the weeklies at the end of the month if they fall in the same week. So, for example, if the end of the month is a Wednesday, it's not technically the Wednesday weekly series. It's the end of month option. It doesn't really make much of a difference. It's still an SPX.W, I believe. And of course, the PM expiring options will use the standard Friday close of SPX or GSPC's Yahoo Finance for their expiration date. Now, this is just right off of CBOE.com, just for more clarity of all the different styles of SPX options there technically are. But in general, to answer your question directly, why options traders would ever deal with the SPX AM options with all their overnight pricing rather than stick with the regular SPX options? And it's really choice, is what it comes down to. There are many systems, many strategies that teach SPX, NDX options, and so forth that have been tested and used over the years, whether it be iron condors, whether it be credit spreads based on the current trend of the market itself. But they've been traded and tested for years, and investors just continue to use them because they're based on 30-day out, using this cycle, knowing the management techniques, knowing the triggers. And the investors that use those, and again, a lot of them are floor traders too, Robert, but the investors that use those know that, hey, if on Thursday we're coming up and we're maybe within 0.4 or 0.5% of a strike price that we don't want violated, they're usually rolling it out to the next month or closing the position at that time. They're not going to take that chance. But if it's 1, maybe 1.5%, maybe 2%, usually you don't see those type of movements that big. Now, it's been a volatile market. We've seen some strange opens on Fridays and strange opens on other days as well. That is a risk, of course, and that sort of is a reason that the weeklies can be very useful. Not only for trading those same strategies such as spreads, because if I'm doing weeklies or 2 weeks out, I'm going to be getting a better annualized return than going month by month by month with the AM settled series. But it doesn't mean that it still doesn't come with risk. Even if I have a PM settlement on a weekly that would have the same type of spread that would have been my monthly with an AM settled, well, Friday morning that can still open weird and I can still be in trouble on a position that looked like it was profitable on Thursday. I just have the benefit of waiting until 4 o'clock that day to make an adjustment, roll it out, see which position I want to adjust to, and so forth. So it offers a chance to play shorter term, different market conditions. But yes, since the weeklies by definition only go out about 7 cycles, if you want to do a poor man's covered call on SPX, you're going to have to use the AM settled for that far out option and sell the near term options against it. They just don't have a PM settlement out beyond the extent of the 7 cycles of the weeklies, because the AM settled options are the standard for SPX. That is the regular ones, not the PM settled. The PM settled only came out several years ago when all the weeklies started to happen. They decided to make them weekly PM expiration, and then they had to add that extra PM on the 3rd Friday, because you do have the AM settle and a PM settle on the 3rd Friday of the month now, denoted, of course, by that root symbol SPXW. The real answer is it's just by choice. Investors who have been doing it for years and years and years before the weeklies even came out, they know the structures they want for the AM settled. They've been working with the AM settled for years. They just feel more comfortable continuing to do that. That's really what it is. But if you're more comfortable with the PM settled, the way that you trade and the way that you evaluate positions, Robert, there's absolutely nothing wrong with using the weekly cycles and using the PM cycles. But as you mentioned, you won't be able to do that if we're doing a 4, 5, or 6 month out straddle or strangle, a poor man's covered call, diagonal calendar spread, horizontal calendar spread, or things of that nature. You're going to have to start with the AM settled option if you're that far out in time. All right, now on that note, real quick, let's just navigate over to Power Options. There's a quick discussion there for Robert in that case. And both, I think, both the AM and the PM have the same tax benefits as far as the index trading goes, which also makes them very popular as well. Either way, AM or PM. All right, well, while we're here, though, let's just keep going with that question there. Let's just go to the SPX chain. And all this takes a while to load because there's so many cycles. But let's go ahead and go to the chain. And let's see, let's just look at calls. So now let's look at puts. And let's go to next week is the 10th. Is that correct? So we'll look at the standard weekly. We're not going to muck around with the Monday, Wednesday stuff. We're just going to look for next Friday. I am on a small chain, but it's still huge. I'm sorry, folks, for the scrolling. Okay, good. There it is. Just want to make sure I see it. Good. All right, now, hold on 1 second. Let's just scroll down here. There we go. All right, I wanted to go to the at the money options here. And these 2 columns is the active volume today, current option volume, 3,088 at the 4,100, 237, 1,005, open interest of 1773, that's going to jump up naturally with this volume here today, 268 and 163. So good activity. This is for next Friday, but we don't see a lot. You know, we see some down here at the lower strikes too, 40.50. This 35.10 and 30.88, that might be linked in a bull put credit spread or maybe even a bear put debit spread. It'd be interesting, but since those numbers are in the 3,000s, oh, here's another one, 40.25 to 40.50. Maybe these are kind of linked to each other. Maybe that's a big contract bull put credit spread. Yes, we don't know for sure, but that's just something that we can see because there's a lot of those numbers that are sticking out there that are in high volume at different strikes. They might all be linked together somehow. And there's, of course, 7,600 down here. That could be part of two of those. In any case, we're seeing some relative numbers here and good volume. But the reason why I wanted to show that real quick is, of course, if we go back now, let's go to our standard June 17th expiration. Why is there a 16th? Anyway, sorry about that. Now we're going to June 17th, and we're going to go to this. This is the standard June expiration for SPX. You know, same at the money strikes. And it's not as high as I expected, but you still see a lot of big numbers here today. That could have been people rolling the positions out today, Robert, to 2 weeks out in time. What I was trying to just show here is that there is still, look at this one. Look at this open interest here, 4,100. Oh, sorry, 41,000 with 9,000 contracts traded today. 8,000 open interest with 1,000 contracts traded today. I just wanted to show you this to illustrate that there is still tons of activity. 10,000 open interest, 13,000 open interest, 680. We weren't seeing that on the weeklies. A lot of floor traders, a lot of other investors. You're still going to see a lot of activity on the AM settled options because those are the regular ones. Those are the ones that most long-term investors know. They probably got into the weeklies a little bit, Robert, but this is what they know. Investors have been trading since the 90s, since 2000, you know, so forth. That's what they've been using because that's the standard to them is the AM settled. Let's go far out in time. Okay, let's go to those leaps. How about that? Let's go to January 2023 here. And again, I'll scroll down. There we go. And you still see a ton of activity, open interest in the thousands, tens of thousands, 10,000 here. Not a lot of active volume, but still 4,000 contracts here. That might be linked to a calendar spread with some of the 3,000 we saw for next week's expiration. Always a possibility, Robert. But many investors are still choosing to stick with the AM, whether they're monthlies, whether they're 1 month out, whether the leaps that you were looking at, whether they're 4 or 5 months out based on the strategies that they use. The AM settles are the standard regular options. They're always going to be used. Floor traders, they're always going to be populated by investors who have used them consistently over time. Okay, so I hope that answers your question, Robert. I just wanted to make that a little bit clearer, and so we could take a look at the volume and see that as well. Bryan made a comment here a little while ago. Oh, sorry, I want to go to option chain. Bryan said, BHP, that was BHP I was referring to with all the options changing to non-standard on June 2nd. Okay, so I guess there's another root series that's non-standard. What do we mean by non-standard? Of course, that means that there's a series out there on BHP which represents more. It represents more than just a standard 100 shares of BHP. If there was a spinoff or a split or something along those lines, or a special dividend, that's rare. Shares of the stock that you're in BHP plus potential cash settlement as well. So it might be 89 shares plus a cash settlement to pay out if you're assigned or if you're closing the position. Or it could be, 78 shares of this stock and 22 shares of this stock as well. You said Woodside Petroleum, and it complicates selling options, thinking about liquidating. I'll be honest with you, Bryan, that's an approach that Ernie uses, meaning that if he's in a position and there's a spinoff, and now the roots have become non-standard, meaning they represent more than the standard 100 shares, of the underlying stock, where it's shares in cash or shares of this company plus shares of this company and so forth. He usually just liquidates out of the position and either goes to something different or starts the position over once standard routes come back out. Sometimes the standard routes will come out maybe a month or two later. So he'll just reopen the position if he likes it, Brian, I'm sorry. And then he'll go into the more standard options if they're available. So a lot of times when you see a split like that happen, for the first little while, 3 weeks to 4 weeks, maybe a little bit longer, you will only see, okay. We're not even tracking it in the system. I think that's what you meant. We're not, that's the other reason Ernie doesn't like to do it. But you'll see the non-standard options, and then maybe 3 to 4 weeks later, you start to see another series come out, which is back to just regular 100 shares. After the existing, you've passed through maybe one or two existing options expirations. When the new options are rolled out, those new options in their cycle may be standard options, back to standard options. But yes, because of the problems with the calculation, meaning that when I go to do a covered call search, for example, the return calculations for percent if assigned annual, downside protection, percent if unchanged, that's all based on assuming 100 shares and the call you're selling represents the same amount. I'm selling this for $880 here on PDD. Now, if it's a non-standard option, I still might be collecting $880, but I'm delivering a certain number of shares of stock plus the cash settlement, which might equal more than 100 shares. It might equal 105. It might equal 110 with the cash settlement that is in addition to just getting assigned on the position, in which case these numbers are not accurate. It's completely different. We don't have a background equation to handle all of that for all the different scenarios that pop up with these non-standard options. So we just do not include non-standard options and power options. You can't search for them. You can't track them in the portfolio. Once or twice we made an adjustment when a very big stock that a lot of customers had positions in did that. This was back in 2009 or 2010, I think. We allowed the non-standard options to be tracked in the portfolio because so many customers had asked. I can't remember if it was Microsoft or Hewlett Packard. It was one of those, or Xerox. It was one of those big companies at the time. And we decided to put it in to track so you could see the numbers, with the caveat that the return you're seeing is not accurate because there's additional settlement to this beyond the 100 shares. But we didn't include it in the searches because the numbers you see for the returns and the downside protection, the naked yields and so forth weren't accurate because of the special delivery. But just to sum that up, Brian, I've heard him have several discussions over the years with investors who called up during a coaching session and asked him, hey, I've got a position that just did a spinoff. I've got a position that just did this. I don't really want to own both companies. Should I just sell the one company that I got the spinoff from? Should I close out the calls that I currently have as covered calls that have this non-standard and wait for the standard? And Ernie's response was always just liquidate the position. Don't have to mess around with the funky numbers and the special delivery requirements. Just liquidate it if you're in a good position, profit or small loss, and you're comfortable with that. If you still like the stock 30 to 40 days down the line, by that point, there might be standard options again available on that, Brian, which we're back to the normal one contract equals 100 shares and no other cash and no other stocks involved. And we're back to normal. And you know your numbers are direct in those cases. So, that's something to consider looking into there as a potential means of managing that. Wait to see if don't do anything and wait to see if there are more standard ones, or just liquidate the position as well. Okay. Oh, yeah, and you said much chance of T going to all non-standard. I don't think there's much chance. The desire is for when there's that little spinoff, the WBD and everything like that, when there's that type of spinoff on a position for options trading, the goal is to get it back to standard, all standard. But what does happen in those situations, Brian, is the options that existed at the time had to be adjusted. The expiration cycles that were open when that sort of spinoff and that happened, they have to be adjusted. When that happened, let's just look at the chain for T. There's regular ones now. There's the 1 series and the 2 series, I think it is, T1 and T2. I can't remember exactly. But when that spinoff happened, I'm just going to take a guess here. It's possible that the September series wasn't even available for AT&T. You know, why don't I have every month? I mean, this one has a lot. But the options are released in a cycle. See, there's no August option yet for TNT. That's going to come out after June expiration. You do have Septembers, you do have Octobers, you do have Novembers. The August will not be released till the Monday following June expiration. The August is probably going to be standard. It's going to be in this T1 or whichever one is the standard one, the T1 now. It's probably going to be standard because the desire for the market, the desire for the exchange is to have all options going forward and all new options that come out be 100 shares to one contract. Because those options didn't exist when that happened. So the new options that come out are going to be in this cycle that should be 1-to-1 in those cases. The market wants that. The exchanges want that. They want that to happen. They want it to go to normal so it's a fair playing field. But any options that already existed when that spinoff happened had to be adjusted. But the new ones that come out after that don't need to be adjusted because they weren't a part of it. They are just representing 100 shares of T right now.